Welcome to the Maryland Mortgage Rate Weekly Mortgage Market Update for the week of May 18, 2015. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week was certainly kind to Maryland mortgage rates. If you take a look at the bond chart on the screen, we can see, if we go back to April there, mortgage bonds have just been selling off, not able to find a floor of support, just selling off all the way till last week. Finally found this floor of support. Thursday we were able to bounce higher. Friday gapped even higher. Now the short-term trend is for the bonds to recover and bounce off this low. Now if you look at the next chart on the screen, you can see there that that big line, that's a 2-year chart showing the 2-year trend for mortgage bonds has been for bonds to trade higher as long as they didn't break below that line of support. Well, last week was the first week we actually dipped below that layer of support, as you can see there. If we would not have closed higher above that at the 200-day moving average, that would have been very bad news. We continued our locking recommendation. Bonds would have sold off. Rates would have continued to jump higher. But great news is Friday, bonds recovered, gapped higher. We closed above the 200-day moving average. Very bullish signal. So with that in mind, we're going to recommend floating your Maryland mortgage rate to start the week to see if bonds can improve on this momentum and get back some of what we lost since the beginning of middle of April. Now, if we dig into the economic news, big report last week was the retail sales report for April 2015. It was a stinker. No improvement, 0% change between March and April, and March wasn't good either. So retail sales report, not good. That shows consumers are not spending. Even though they're saving money at the pump with the lower gas prices, they're banking that in their savings account because they're not feeling great about the economy. So that's going to be a drag on the economy. We saw that with the readings in the GDP, so we'll have to keep a lookout on that. So with the bad economic reports coming out, we don't see any reason for the Feds to raise their short-term interest rates, not until 2016, so keep an eye on that. Now, then we had a report on wholesale inflation. That's inflation at the wholesale level for manufacturers. That was the Producer Price Index, or PPI, for April 2015, and it was down 0.4%. So it came out negative 0.4%, better than expectations of 0.2%. That's actually deflationary. Costs actually went down on manufacturing costs. So that doesn't always translate into consumers, but it definitely shows that we don't have much inflation going on, even with rates as low as they are. Then we saw weekly initial jobless claims come out on Thursday. Great report, 264,000 claims, down 1,000 from the previous week, well below expectations, 275, and at a 15-year low. So very good reading on employment from the weekly initial jobless claims. Next week's report will be the one that's used for the May jobs report, so we'll have to keep an eye on that. And then in other economic news abroad, China's central bank, the People's Bank of China, lowered its lending rates on 1-year term lending and 1-year deposits. They dropped it 25 basis points because of the weakness in their economy. They're trying to prop up their economy like the United States have done with us lowering our lending rate and keeping them all-time low. So with central banks around the world lowering their short-term interest rates, we don't see how the Federal Reserve and the United States can raise theirs without making us uncompetitive and hurting our exports. So again, I don't think they're going to raise rates this year. We see it happen in 2016. Then in housing news, CoreLogic released their national foreclosure report for March 2015. Continues to show improvement. Only 542,000 homes were in some form of foreclosure compared to 729,000 homes the previous year. That's a drop of 25.7%. So that's great news there. The foreclosure inventory represents only 1.4% of all homes. That's down from 1.9% last year. So great news on the foreclosure front. And then FHA announced some changes to their single-family mortgage program. They're changing their handbook, which changes their guidelines. It was supposed to go into effect June 15th. They pushed it back to September 15th. A lot of guideline changes. The big one a lot of people aren't aware of is how they're going to handle student loan debt. Currently, if you're going to apply for an FHA loan, and your student loans will be deferred for at least 12 months past closing, we don't have to count those debts in your qualifying ratios. September 15th, that's no longer true. We're going to have to get a payment and count them in your debts. There's no more deferment for FHA loans. That's huge. So anyone right now that's qualified, deferring their student loans, needs to get under contract by September. That's big news. And then USDA Rural Housing Program is still currently about a 10-day turn time on underwriting files submitted in Maryland. So please plan accordingly when you're scheduling your closings for a USDA loan. And then in the local news, we've got the first-time homebuyer seminar coming up in June. We've got a couple of them. We've got one in Laurel, Maryland, and we've got one in Towson, Maryland. So you can check the website for those dates. That's www.marylandhomebuyerseminars.com, or you can give us a call in the office, 410-412-3319. Look forward to seeing you guys next week.